So hello everyone, and these are the videos now for chapter 14, and we're going to talk a lot about financial derivatives. They are really important, so we're going to talk about them. So financial derivatives are basically contracts. For the most part, they're just contracts, and these contracts have an underlying simpler asset that they're working off. And the purpose of financial derivatives is to basically reduce risk. And there's a couple types: forward contracts, financial futures, options, and swaps. And there's many different types of swaps, and there's many different types of options. And of course, there's hundreds and hundreds of all of them, of futures and forwards. Okay, there's interest rate swaps and credit default swaps. And so there's many products, so to speak. All of these have many different types of products, and we'll spend some time talking about those. All right, so we're going to define what a hedge is, and the word hedge simply implies reducing risk. You hedge your position to reduce your risk. Okay, and then we're going to talk about a long position in one of these contracts. And then we're going to talk about a short position in one of these contracts. A long position means you bought something and you're trying to make a profit if the price goes up. And a short position means basically you sold something and you're trying to make a profit if the price goes down. All right. You might have heard people talk about shorting stocks, right? And the people who shorted stocks during the global pandemic, when the market dropped, they made a fortune because they were short the stock and they bought it down back at a cheaper price. All right, so we're going to define a forward contract, and then we're going to summarize the advantages and disadvantages, and talk about the difference between a forward and a futures contract. We're going to identify the three types of option contracts, and we're going to talk about calls and puts. Okay. We're going to talk about calls and puts. So there's going to be a lot of terms involved here with the contracts. Whoops, hold on. Let's jump ahead a little bit. And then we'll look at a swap. We'll define what a swap is. And interest rate swaps, basically, you sell, you take a position in an interest rate swap so you can get out of a high interest rate and go into a lower interest rate if you have a loan. So you have interest rate swaps. And then we'll talk about three types of credit derivatives. Okay, so there's many different types of derivatives, and we could spend a whole semester talking about that. All right, so as I said, when you hedge, you're trying to reduce or eliminate risk. So you're taking a position that eliminates risk, okay? So you normally would use financial derivatives. One of the reasons you use them is as a hedge to reduce risk. There's another use too, and that's called to speculate and try to simply make money. But people who are engaged in businesses will use derivatives to hedge or reduce risk, just as it says here. So this is an important statement. Eliminate risk. And you could either take a long position, right? Or you could take a short position. All right, so hedging risk, here's a nice definition here, involves engaging in a financial transaction that offsets a long position by taking an additional short position. So this is a good statement. Or offsets a short position by taking an additional long position. So this is vice versa, right? So it's vice versa. But in any case, you're just simply trying to eliminate risk. And how do you eliminate risk in real life with us, right? Without when we buy car insurance, right? And we buy home insurance, right? We're trying to reduce our risk, and we pay premiums, and that's what that's all about. All right. So a forward contract, first of all, let me just say this. A forward contract is a customized contract, and it's customized and it's got custom features. That makes it difficult to basically sell like you would sell stock in the stock market. And so it's an agreement between two parties to engage in a financial transaction at a future, and the word future and forward is synonymous here, point in time. So this is an agreement, and future and forward are kind of like synonymous, right? Okay, and basically, part of this contract and part of the details of the contract, of the agreement, is that something will be physically delivered at a future date. Okay, so something is going to be delivered. So there's a contract for something to be delivered. So we'll highlight delivered. Okay. And another feature of the contract is the amount that's. So these are all the features of the contracts here. The amount that's going to be delivered, right? And of course, the price. So we got the price that you're going to pay when it's delivered. And in this case, we're talking about interest rate forward contracts, but there are forward contracts written on many different types of things, right? So in this particular case, we're talking about, and so basically, this could be currency too, right? And the date on which delivery will take place, and of course the date, right? So all the features are called out in the contract. And being that it's customized, there's a lot of flexibility built into these contracts because it's between you and another party, right? It ain't like you're going to sell stock. And as I just mentioned a minute or two ago, it's hard to find someone to sell it to, and you got to find a counterparty who's willing to go into this with you. So, okay. And of course, you got to worry about one side defaulting, right? And that's always a case with financial markets. You worry about default, right? So these are all important highlights that you got to kind of concern yourself with. All right. So as I just said, financial futures contracts are similar to interest rate forward contracts, but these are exchange traded for the most part. They're exchange traded, and they're not customized. They have standardized features that allow them to be traded on exchanges. So basically, they eliminate the problem of having to find someone, and you could actually resell these, and they're very liquid because they're standardized, and it removes a lot of the scary problems associated with default. Okay. So as the futures contract, now we're talking about exchange traded. As it gets close to the expiration date, the price of the contract is going to converge, right? So this converges to the price of the underlying asset to be delivered. So this is an important statement here, if I can get it to highlight. So it converges to the price. So now we're talking about the exchange traded financial futures here, right? You'll get a convergence. All right. So here's some terms associated with futures contracts. So March 236s of 2030 are long-term bonds to be delivered to the Chicago Board of Trade futures contract expiring in 1 year, March 2014. So interest is now this is the interest rate, right? Interest is expected to stay at 6% for the next year. So 6%, right? And this is the maturity date of the bond. But this is the basically the maturity date of the contract. Now this could be bought and sold, this contract, prior to the expiration of the futures contract expiring. So you see, we got this future contract here. All right, so see, you can see interest is expected to stay at 6% for the next year. So the sixes of 2030 in the futures contract are selling at par. Selling at par, obviously, you should know, it means it's at its face value, okay? That's its face value. Now you want to offset the long position in the bond with short positions, so and selling a futures contract, right? So this is what the purpose of this contract is. You may have the bonds and physically hold them, but you don't want to take a chance. So you take a short position selling the futures contract, okay? All right, so if interest rates increase over the next year to 8%, the value of the bonds is going to be $4,039, and the value on March 2013 was $5,000. So the price of your bonds, the physical bonds you're holding, go down, right? It goes down. So you don't want to lose money on the bonds because interest rates went up, right? Interest rates go up and the price of the bond went down, okay? So you don't want that to happen, all right? So that's why you would perform a hedge. So now you sell the futures contract and you perform the hedge. So you take a short position in the futures contract, okay, to hedge against the price of the bond going down. And that has a value of $4,039.64. But the buyer of the futures contract agreed to pay you $5 million on the maturity date. So you see, this is a perfect hedge. You lost on the long holding the bond, but now the short hedge on the futures contract offset it. So this is, as it says here, this has been a perfectly successful hedge. You lost on one like a seesaw, but you made on the other, right? You basically balanced out perfectly. So you balanced out perfectly. All right. So these contracts are traded on organized exchanges all over the world, many in Chicago in the United States, the Chicago Board Options Exchange, the Chicago Mercantile Exchange. There's many derivative trading organizations. There's Eurex in Frankfurt, Germany. And the important thing is they're organized exchanges. And they're regulated by the Commodities Futures Trading Commission here. And basically that's what they do. And they try to make sure there's no hanky-panky. That says manipulated, but basically no hanky-panky. So registers and audits brokers, there's traders and there's exchanges. Okay. So they approve, the CFTC approves futures contracts to ensure they serve the public interest. So everyone basically who is going to sell these contracts here, the brokers, the traders, and the exchanges, they're registered and audited by the Commodities Futures Trading Commission. So that's important to know. And now, again, as I said, it's all over it's all globalized, right? Globalization. So it takes place all over the world, right? If I could, sometimes it gets stuck here. And That's an important point. If I could just get this. All right. It's globalized, and trading is taking place all the time. You could find out the futures contracts and all the contracts if you get up like early in the morning, 5 o'clock, like I do, and see where the market's heading for the day. So these are important ideas. These are important ideas here. So on the next two slides, this slide and the next one, they list many traded financial futures contracts. You can see this is just a sampling, and these are on treasuries, right? Interest rate contracts on treasuries, all types of bonds and notes. And here's the futures contracts on stock indexes, the S&P 500, and they even have one on the Dow. So, and this is the contract size. And this was the open interest as of July 2017. And here's currencies, yen, euro. So there's futures contracts, hundreds of them, on all different currencies and everything. And they all have their own contract size. And you could read up on these, and I'll give you some links on this stuff, okay? All right, I'll end this here because this is getting a little large now, and it takes about a half hour to get processed and loaded up, and then I'll do a part 2. So this is part 1 on chapter 14, Financial Derivatives.